Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn from Focus Compounding, sitting next to my co-founder, Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, first of all, welcome. Second of all, be sure to check out all the content we put out into the internet. Go to my Twitter, @Focus Compound. All the information is down below. That's the best place to get everything out there that we put into the investment universe. If you're interested in learning more about our money management services, we have a fund and we also have separate managed accounts. There's different qualifications for each, but you could get more information on that by going to focuscompounding.com and hitting the Invest With Us tab, and that'll take you to give you all the information you would want on that. Or you can just reach out to me at andrew@focuscompounding.com. So we got some exciting news, very exciting.
Okay.
We are going to be in Omaha this year for the Berkshire Hathaway meeting, the annual general meeting. Super excited for it. Jeff and I will be in Omaha Thursday, the 28th through Sunday, May 1st. And Willow Oak Asset Management, which is a partner of Focus Compound Capital Management, they are hosting an event at Omaha Marriott downtown at the Capital District. And the event is going to be going on from 5 o'clock is when the reception starts, and it ends at 8 p.m. And somewhere in between, from 6 to 8 p.m., there's going to be an investment panel with a Q&A. And everybody, I guess you're wondering, who's going to be a part of this Q&A? Well, let me tell you. Jeff is going to be a part of it. Stephen Keel, Keith Smith, and Shree of SVN Capital is going to be a part of it. And yours truly, me, the voice you've come to listen and ask the questions of investment managers. Myself, Andrew Kuhn, I'm going to be the one asking these great managers questions. So it's going to be a lot of fun. Looking forward to it. You could sign up for this at willowoakfunds.com. Go there. It'll have all the information. Register for it. We're looking forward to meeting with you in person. If you're an investor and you're interested in our money management services, our investment services, and you want to schedule a meeting, email me, andrew@focuscompounding.com. I'm looking to have that whole weekend booked out. And as I said, we do land in Omaha Thursday afternoon, the 28th, and we do leave Sunday afternoon, May 1st. So if you're interested, reach out to me, andrew@focuscompounding.com. So in today's podcast, we are going to revisit your singular diligence archives. We had a tradition of doing this. I think we've done it once or twice. And I figured why not go over it again in 2022, largely because the stock market has been more volatile lately. And maybe it's a good time to look at some of these companies. So before we do that, all of these businesses, this isn't like the typical buying, $1 for 50 cents value flip. These are all very high quality, predictable businesses. And I think these are great companies to have on your watch list for when there's a potential sell-off in the company or in the stock, you would be able to, hopefully take advantage of it. Is that fair to say, Jeff?
Yeah, the reports were more on the business overall. It had a little bit about value, margin of safety, things like that. But it was like, 10,000 words. And I'd say probably 7,000 or 8,000 of that is probably focused more on the business, the industry, the quality of it, things like that. So, but sometimes price was a big part of it. But the reports are mostly about like the business model and those sorts of things.
Okay, so the first one, America's Car-Mart. Do you remember when you wrote this up? Is there a date in here? Originally published June of 2014, the Abbott Hog, issue 8, America's Car-Mart. Stock price at the time was $38.37. Should we compare it to see where it's at today?
Yeah, it's probably cheaper today. I mean, it's the price is much higher, but the stock is probably cheaper on like a price to earnings and actually most of those basis. Yeah, I think even if we check price to sales and stuff, I think it would probably be a little cheaper now. Price to book, I don't think it's much more expensive.
We could see. We could look at it. Okay, so currently trading price to sales 0.5, price to book 1.2. And I know you have your...
Yeah, I have a chart there. So it was EV to sales and stuff like that, I'd say, at the time.
At the time, it was 0.92.
Okay.
And we have EV to sales of 0.50 now.
Yeah.
Yeah, so much cheaper.
So the stock looks more expensive. You know, the stock price, obviously, it's been, 8 years? Not quite, but it's basically 8 years. So the stock's up 2.5 times, something like that. And, but it's actually quite a bit cheaper on things like price to sales, yeah.
So that's usually a good thing to see.
Well, the stock has been compounding over time at probably about 15% a year. If you look at like earnings per share growth and per share growth in book value probably and all of that, if we go like far enough back, because they bought back their stock and everything. So it's not far from about 15%, because like sort of the return on their portfolio is about 15%. And so they've only grown less. They don't pay dividends. They buy back stock. So they only have grown less than 15% per share if they've kind of failed to put all of their money back in at a reasonable price. So like if the stock got too expensive, they wouldn't be able to grow at 15% a year because, you know, they wouldn't be able to buy back stock at a low enough multiple. But over a long period of time, I'd say they're pretty close to that, about a 15% compound annual growth rate. So, you know, 15%, if they'd managed that, I mean, we could see what was their sales when I had it go through 2013 was when I did it. So sales of that year were what?
465 million.
Okay, and what are they now?
They are, let's see, we are on the balance sheet, 919 million as of 2021.
Yeah, and trailing 12 months, even higher.
1.1 billion.
1.1 billion, yeah. And then share counts probably also come down during that time.
Yeah, so you have it right here from 2013. I mean, diluted shares outstanding 10 million, and now it's 7 million.
Yeah. So obviously on a per share basis, sales of per share have gone up quite a bit. Yeah. Because, I mean, so the business is more than doubled, quite a bit more than doubled anyway. And then it's also cut its share count by a lot.
What originally appealed you, or I guess drew you into Car-Mart to want to do a report on it?
That's a good question. I think I would guess that it was mainly not my idea. So I did single diligence with another person, and they did all the notes and things like that for it. A lot of the research. We picked the stock in the beginning. They do a bunch of research. Then I do stuff at the end, all that. And I would guess that this would be one of the ones that he picked originally as being interested in. We eventually did more bank stuff. And so this had probably some appeal as it was a financial thing really, but it's tied to car things. Obviously it has like a very specific business model. There aren't a lot of buy here, pay here type car dealers that are traded publicly. This was also in a part of the country. It's a relatively small part of the country, kind of more unique that way. It's easy to analyze from the perspective of what the balance sheet does and all that, because they have the receivables on it, so you can very easily see kind of the loan book. I also think probably the fact that it was buying back stock over a long period of time. So not paying dividends and just buying back stock is extremely rare. You just don't find companies that are like that. Either companies just buy back stock to offset dilution and they don't pay dividends. You see that plenty. And then you see companies that do both, but that definitely would appeal to us. So you could see, the rates that they charge on their loans and stuff are like 15%. And you see them buying back stock. So pretty simple to figure out whether it's a good enough business. Because you just have to figure out they're really reinvesting more and more in buying back their own stock, and they're just reinvesting in the loans that they're making at pretty much the same kind of terms over time. We've talked a lot about the stock before. I don't know that it's as safe as it was before, in the sense that I think the terms have extended more and all that. But there's inflation now, and that complicates things. I don't think they'll have a lot of charge-offs, but I just think in the long run, maybe there's been a little more competition. They've talked about securitizing. That's something that they might do. And they talked about being more sales oriented. Those are two things that kind of worry me a little bit compared to what their model was in the past. One of the interesting things about it was that this is in a heavily securitized industry. I think collections is important. They've said that they're a collection focused company in the past. They want to be more sales focused in the future. The more securitized something becomes, the more commoditized it becomes. And, we'll see in the long run if this becomes a less attractive business. They might outgrow their niche too. Obviously, it's a pretty small company. If you think about selling cars and you're only doing $1 billion a year. Yeah.
Mm-hmm. Is this a company that you would be interested in at the right price even today, though, or are those real concerns that you just outlined that kind of put it in a too hard pile?
I'd be interested. I think it's more attractive than most stocks today.
And it's funny, too, that this stock is, 50% cheaper almost from when you first wrote up the stock.
Yeah. Now, since the pandemic, it did have an unusually good growth period.
Mm-hmm.
But I think it hasn't benefited them as much as it would someone who's just a car dealer, actually. So, no, I think it's actually very attractive compared to another. You can actually look. There's some like mediocre credit card companies and stuff that trade at almost twice on a price to earnings basis, and maybe even a little bit more. The one thing I guess is people look at price to book, right? And so this is above book. But to be fair about that, and then there was always been this argument that people make, which is you should buy it at like the below the average price, the average multiple is traded at in the past. So obviously PE and things like that is cheap now. But the argument would be at times that like, well, price to book, it's actually been pretty low, so you want to buy it pretty low. But if you look at a long-term chart, it's far outperformed. Can you do a chart where you can show the long-term stock chart so I can give you an idea?
We got it on over-the-counter markets.
Yeah. So if you compare that to the S&P 500, which you just click compare and then, the bottom one. All right. This is why I don't think it's relevant what it's traded at in the past, because it's always been underpriced. So we have a chart here that goes back how far?
It goes back to, looks like 1992.
Okay. All right. So almost 30 years this chart goes. And what's the percentage gain in the S&P 500?
900%.
And what is it in Car-Mart?
20,674.
Right. And like...
Big difference.
Basically, from the time you bought it, you'd be ahead in Car-Mart, and it's never close that the S&P would ever get remotely close to catching up to it. Now, you could look and you could do over short periods of time, be like, well, over the last 5 years, it's only just barely outperformed. Still outperformed it, right?
So over the last 5 years, S&P 500, 78%, Car-Mart, 143%. So significant outperformance.
And not only that, but again, if you bought 5 years ago, what days would you have been behind at any point? I'm trying to see. Did it happen in COVID?
No, it was still ahead of COVID.
Yeah. So again, it's not that we're just picking the exact right dates. We picked a 30-year date and a 5-year date. They're kind of arbitrary. But so if you pick a shorter date, we can see underperformance over 2 years or something like that. But that's not really relevant to me. 5 years to me is way too short too, because if you think about it, what's the S&P 500's PE? 3-4 times the PE of this stock. What's its price to book? What's its price to sales? It's extremely. The S&P 500 is way more expensive than Car-Mart, and Car-Mart has a better history of providing returns in the past.
So I was going to say, so what does that tell you then? When there's this huge discrepancy, but a company like Car-Mart doesn't trade anywhere near the multiple, does that mean that all of the growth in the stock has come from the internal generation of the company as opposed to multiple expansion?
Yeah, of course. So I think the stock chart thing is just useful to learn about a company over a long period of time. I have no problem with a stock underperforming the S&P 500 over a long period of time if you can figure out why it happened, if the business has changed, whatever. And just outperforming because it's more expensive doesn't help. But this is pretty easy because it's much cheaper. You can see in the if we look at like QuickFS, right? So can we look at the 20-year?
Yeah, sure.
Okay, so if we look at the 20-year, we can get some idea of how much of this performance over 20, 30 years is from expansion in the multiples. So if we look, we've got, let's see, if you go to the...
It's going to open up.
Yeah.
Okay.
So if you go to the, let's say ratios. Let's try ratios. Yeah, this will work. So if you go down, you can see market cap and all that right at the bottom. Doesn't use market cap and the price multiples. Okay. So market cap, this was a small company at one time, right?
Yep, 93 million.
Okay, so market cap's up 10 times or something? All right, in 20 years or 19 years. But you can see that the stock is actually up more than that, right? The stock's up closer to 18, 19 times. I don't know, closer to 20 times. Almost half of it's come from share declines, share outstanding declines.
Yeah.
And half from growth in the company. That is,
shares outstanding decline is what you're saying.
Shares outstanding decline and drove. So let's say it's been close to a 20 bag. Let's say it's 18. I don't know how much of a bagger it is, but not anymore because it's dropped, right? So that was at its peak. So now we're talking about something that's only up 10, 11 times.
Yeah, because it's 557 million market cap now.
Yeah, so it's only up 11 or whatever times. So that means that the company's only increased. Actually, that means the company's increase has basically driven all of it, right? Mm-hmm. We can look. What was the price multiple 20 years ago?
Price to earnings, negative. Price to book, 1.7 times. Price to sales, 0.73.
So it's actually declined.
Yeah, because it's a 0.5 now.
Right. So anyway, you've had a stock that over 20 years. So over 20 years is still up, 11 times? Mm-hmm. Something like that? The stock price?
Yeah.
It was $8. Yeah. So it's up 11 times or something over 20 years. And that's with declines in the actual multiples. Because you can see, the easiest one to look at is tangible book value. You have that in the per share figures in the bottom line. Mm-hmm. So it's a pretty good guide to how much the business has actually grown per share. So what was it 20 years ago?
$5.18.
And today it's getting close to 60.
Yep. Mm-hmm.
Yeah. So, that's a pretty good number when you compare it to the S&P. So the internal rate of the performance has been better than, the market generally. So it's been underpriced. Mm-hmm. However, you do have to keep in mind that is driven by the performance of the stock long-term, or the performance of things like tangible book value growth has been helped by the fact the stock was relatively cheap most of the time. That's very important, actually. See, if they'd done major buybacks when the stock was expensive, this wouldn't work. So, because we talked about this before, but that means they would have had to grow their actual business a lot more. So a huge advantage for this stock over the time it's been listed is that it's been relatively cheap. And we can see that if we look at the average price to earnings, for instance. I think price to book is more useful, but price to earnings, if you look at the bottom, it's rarely had years where it's expensive, mm-hmm. right?
Yeah, certainly cheaper than even, we have 18 and a half times. And what year was that? 2016. But other than that, it's always been 10 and below, or kind of around there.
The easiest way to do this is if you just highlight price to book there for all 20 years. If you highlight them, this will give you the average.
You want me to take the average?
Yeah, you could. If Excel will automatically do it if you select all of the cells.
1.76%.
Okay.
Or 1.76 times.
Okay, and then if you go to return on equity, which is up in the top section, you can highlight it for the same years. If you just select those 20 cells, it'll give you the average. It has one negative year, right? So what's the average though?
Let's see. I'll do how I. No, B. 13.4%.
Okay, so you have a 13.4% return on equity over the 20-year average, and what's your price to book average been?
1.76 times.
Okay, so you can see from that your average earnings yield has been fairly low, actually. So you can divide one into the other, basically. So if if you think about this, you divide 13 into 1.75, 1.76 in this case, and then you would just have to invert that and you get the number. What it means basically is the stock is probably traded around 12 to 13 times normalized earnings on average for 20 years, right? Mm-hmm. So if you just bought back the stock on a random day, you'd be buying back at 12 or 13 times earnings. If your stock instead tended to trade at 30 times earnings, then you'd have a real problem.
Sure. Mm-hmm.
Right? The buybacks wouldn't be that effective. Mm-hmm. But the buybacks here are very effective. Now you could just pay it all out in dividends, and if there weren't taxes and things like that, it's not necessarily that there'd be a huge difference for you. You would just receive it in dividends instead of having it back in the business. There's probably not a huge difference in terms of what your returns would be, but the other thing with buybacks is it allows you to alter it a lot. So like if we go to the whether it's cash flow statement, that's probably a good one to look at. So we see the actual buyback size. With dividends, unless you did special dividends all the time, which they could do, it's hard to make it very lumpy. You have regular dividends, But the good thing about buybacks is that you can use all of your available cash to get back down to whatever leverage ratio you want. So if you have a year where you're like in the pandemic, right, coming out of it, they bought back barely anything because they actually had to grow their balance sheet a lot.
Mm-hmm.
But then a few years earlier, they would buy back a lot more. Because if we see in 2021, they bought back a low amount, right? 10 million?
10 million.
10 million. But if you look, their change in working capital was 300 some million, right?
Yep, 358 million.
Right. Whereas a few years before that, their change in working capital was half that amount probably. And so their buyback could be a lot bigger. So that helps a lot. So this is very dependent on that. So you'd have to watch their capital allocation. But yeah, fairly cheap stock. I think it's a fairly good business, but you have to read the annual report about the business and see if it's changed over the, 8 years or something since I wrote it up.
Cool. ARC Restaurants.
Yeah.
So you wrote this one up. It looks like March of
This one
2014.
definitely has not done well.
No.
The stock.
Uh-uh.
And it goes back to even before I wrote it up. Even by the time I wrote it up, it hadn't performed that well. It really peaked around the time of the financial crisis.
Their business model has kind of changed as well, right?
Their business model
fair.
since the time I wrote it up has radically changed.
Yeah. Uh-huh.
Yeah. No, it hadn't changed that much at that time. Yeah.
And when you look at like these numbers, like from a factor like position, like the gross profit, the stability in the margins, the EBITDA, the EBIT, I mean, it looks very much, I mean, you have the variation right here in the standard deviation.
Yeah.
Very low.
Right. And I should also say, like, we're going to look at the stock chart and talk about the stock and everything, but it pays a lot in dividends.
Mm-hmm.
So if you actually add it up over 10 years or something, so you add up the time since I wrote it to today or whatever, a significant amount has been paid on dividends. So it's not like you've actually had a large capital loss without any dividends. Until COVID, they were paying dividends all the time. Their old rate, do you have quick FS for it?
I do.
Their old rate, what was their dividends per share before? It was about $1
about
for 10 years.
Yeah.
Yeah. So, I mean, at least 10 years. So, I mean, you add that up. It's
got a
actually,
lot back, yeah.
although it looks like you've lost $5 a share or whatever in the stock, you've actually been paid $10 or something in dividends during that time. Or you would have if the pandemic hadn't happened. It's very cheap, right? So there's a few factors in here. One, it probably doesn't get enough credit for the real estate that it owns now, which is different from leasing things. It owns outright some restaurants, and you could probably do a sale and lease back of that, or you could do other things in terms of the structure. That they're not really getting credit for the fact that they actually own restaurants. They're definitely being priced like they lease all their restaurants, which isn't true anymore. They also have part of a sports book, which made a tiny bit of money. The only distribution they got from it basically is to cover taxes. So we know that, we can figure out from that how much it's probably making, because it would only need to pay that amount in taxes for their share. If they were making X amount, it's not hard to figure out. So which is the Meadowlands. And if you're into the, wanting to have an investment in online gambling stuff, basically that's sports betting. That's the way to do it. You can possibly make money off that if that continues to grow. But New York has greatly increased theirs, so I don't know if that will continue to be the case. New Jersey had been the biggest state.
Significant insider ownership.
Yeah.
This is the company where I really always like to listen or read the transcripts just to kind of get an idea of like customer behavior, what's going on in like hospitality, because it's always usually a pretty colorful conference call, I would say.
Yeah, and then the really big one is if there was ever to be a casino in Meadowlands, because all that's there is a sports book. Basically, it's a what do you call it? It's a horse racing track, but the not thoroughbred horse racing though. So the whole point of it economically, the only thing that makes any money is the sports book. But they have rights for food and beverage there if they ever build a casino. For all the food and beverage, except if there's a Hard Rock put there, because Hard Rock's a partner. So they get to have a Hard Rock Cafe if they want one. And then they also have an equity ownership. They have an equity ownership in the entity that would be developing the casino if they did that.
So basically, it looks cheap today. They've changed their business model since you've written this up. They've also started going to Florida for a lot of restaurants. And then they have a call option on this Meadowlands project, basically, if they want to put a casino there. But they also have a sports book.
Right. Well, they want to put a casino there, but the
This
state's
needs to
not
get
letting
approved.
them.
Yeah.
But yeah, presumably if the state, given that they have the food and beverage rights and that they have whatever it is, I forget what they've been diluted down to now. It might be 7% or something. They were in the high single digits or something. Then there's some dilution over time. But let's say, and they own 7% or whatever of the, before future dilution of the casino. Obviously, or not obviously, but I would assume that what's the market cap on the stock?
61 million.
Okay. EV says 65 or something like that. That if they developed a casino, presumably that would be worth more than the company's selling for right now. Probably.
The entire casino, or you speaking about
The sports book,
so their share of it all.
The casino would be worth huge. Yeah.
Okay.
But their percentage, right? I'm assuming their percentage has to be diluted down further because either they get called for more capital, they sell out, or they are diluted. There's no way you're going to develop a casino while leaving them with the stake that they have, I think, without having to put more into it.
This is actually kind of a special situation, I would say, this company. You're buying into a business that isn't that cheap, is run by, you call it
by the way, all
owner-operator.
these things except for the sports betting were all true when I wrote the report 8 years ago or whatever. They've changed in terms of buying they've lost
Land.
more leases in the north and bought more things in the south outright. And then there was a change because of COVID with their dividend, and that changed their balance sheet. So financially, they're stronger now financially, you could say, with land and things like that, and just in general. And also they have that's investment and all that. But so there's been some changes, but most things we're talking about were true back then. Because remember, this was voted down, this project. It went to voters and they voted it down.
Overwhelmingly voted it down.
Yeah.
Because they don't want to ruin the monopoly in Atlantic City? Or because they just don't want more gambling in New Jersey? What do you think?
Both of those are possible factors, sure.
Now, do you think there's more incentive for it to go through, considering they have a sports book there that has been successful? Does that help it?
I think states are much more likely to approve projects like this if the legislature does it instead of taking it to the people. I don't think you're going to get a lot of, if you actually let the people vote on it, I don't think they're going to be voting for a lot of gambling things. I think it's much easier to get through the legislature. They couldn't in New Jersey, though. That went to the vote on the referendum, or it's not really a referendum, but a ballot question.
Was it mail-in ballots?
I'm sure it's mail-in ballots now, but I don't think it was when this vote was on. But and so I think if the legislature really wanted to do it, they wouldn't have had to go to a ballot question. The legislature didn't want to do it, so they let it go to a ballot question and fail. I think is the answer. If you had support of the people, the heads of each party in the legislature and the governor and stuff like that, I think that you would get the project done. There's competing stuff right across the river in New York. So I wouldn't at all say that this is definitely going to happen or anything like that.
Now, their business model is not completely, but it is different now. Landry's made an offer to acquire ARC.
Yeah.
That ARC turned down. When was that? And how much was it for?
That was around the time I did the report.
And for like 20 plus.
Unsolicited offer for $22 a share, I think. The stock was trading around there. I think it was around $22 a share. And they said no. They didn't continue to negotiate, though. They just said no. We're not interested. You don't need to make further offers.
Next company, Babcock and Wilcox.
Yeah, there's nothing about this one. The company's been split off. It's too hard for people to figure out. It's in two pieces. Both of them still exist and still trade. One's heavily indebted and exists in much larger market cap than I would assume would be the case. And actually, the other one's gotten a bit cheaper. So the good part of the business, if we look, we could type BWXT in the quick FS, you could see.
No stranger to the pod.
So not cheap, but it hasn't gone up in price much lately. Whereas I'm a little surprised by how much the other half of it has done, considering how bad their financial situation is. So if financial situation had been different, financial conditions had been different a few years ago, that one would have definitely gone under. That one serves like coal power plants and things like that, but they pivoted in a way that was towards a lot of more green stuff, let's say. I guess we could say that, waste to energy and stuff like that. And that was a really big problem, and it caused all sorts of terrible problems for them. So I actually ended up selling that part. My original intention was to keep both pieces of the spinoff, which would have been to keep BWX Technologies and to keep Babcock, what do they call it now? B&W Enterprises, I think they call it. But I decided not to do that other part, not to keep it, because they didn't just stick with the declining coal business over time. They took on certain projects they hadn't really done before, and they had all sorts of problems with it. So it's kind of like how I sold Barnes & Noble when they went from just doing books to really putting a lot down for doing Nook, so ebook stuff. Sold out of that. Same thing here. They really became a very different company. They've kind of changed that, though. They're trying to put things a little bit more back to maybe what they should have been before, but financially the situation is bad. So that you had big dilution stuff on that. I think you could look on the stock chart. If you look on the stock chart for BW, I think that will show you the correct one. Yeah, it should show you just the stock. So it had a reverse split or something. So you can see what happened with the stock, right? So how far does that go back? That only goes back to the spinoff?
Yeah.
Yeah. So if you see, it now looks like it was a $225 stock, right? It was never anything like that. It was like, I don't know, $12 or whatever. It then cratered and has been down at this price. So it lost basically everything. And that wasn't really necessary. I know that they felt that it was a dying business and whatever, and this separated out the good business from the bad business. But they definitely could have carried on with the business that they had. It just would have been declining over time. So it's one of those big questions. Like people talk about NACO or something. We own something like that. It's because of the capital allocation. You have to be very worried with these companies that are in declining businesses that are going to slowly decline over time, like books or coal or whatever. Babcock and Wilcox coal power plants, basically the same sort of business that NACO's in. But if they want to go big into something else that they've never done before, it becomes very risky. And that's what happened here. Same thing with, Barnes & Noble. There's no way they would have gone under if they'd stayed in the business they were in. They might have slowly had problems. But most companies, instead of slowly shrinking the business, decide we're going to keep the business the same size and stuff, and we're going to be able to move into a completely different area, like do something more related to renewable stuff or whatever, instead of doing something that's more related to coal, and then they get into big problems. So, because one of their strengths was coal in the U.S., and where they had a lot of problem was in waste to energy in Europe, which wasn't really their area of a lot of competence. So, and in engineering companies, so they can have overruns and things, and it can go bad really fast.
Banks, Bank of Hawaii.
Yeah, I mean, we can go through all of them just so you can see the prices. Yeah, I remember their name. Yeah,
$74.
Yeah. Let's see. So we got Bank of Hawaii.
BOK Financial.
Frost. BOK and Frost both do energy lending stuff, or did more back then.
Commerce, bank shares.
Yep. And there were other ones that we considered doing but didn't do. Yeah.
Any thoughts on like Bank of Hawaii or BOK Financial? I know banks are on a lot of people's
look at Bank
minds.
of Hawaii. It's just more of like a preference of what people prefer. Bank of Hawaii can't grow very much because it's in Hawaii. So it's not like an organically very fast growing market. If we see, let's look at their earnings per share and stuff. Has there been much movement in that?
Let's see. EPS. It's since, you wrote it up in when was that? Looks like
basically they'd have to buy back a lot of stock.
Yeah, you didn't give
to be able to change things for them. Yeah. Yeah,
EPS has been, it's gone from, let's call it $3.67 in 2012 to $6.35.
Right, but I think a lot of that is just interest rates, because if you look, they had a 30% decline one year, 60% increase the next year. That's just due to net interest margin probably. Let's see, they list in QuickFS net interest margin, right?
They do, yeah.
So net interest margin was 3%, then 2.7, 2.4.
Yep.
Yeah, so that's a major factor in that probably. Yeah, Bank of Hawaii is fine. It's often not been cheap. trades at 2 times book, and that's not a bad price, I guess, because what's their return on equity generally?
16%.
Yeah.
10-year median returns.
Yeah, and if you look, they have the return on equity in Quick Invest for the last 20 years. It's never been below 10%, basically. It's gone around 10% once or twice.
They pay out, dividends as well.
Mm-hmm. So in essence, the most expensive the stock's been is about 20 times earnings, really. If you think about it in terms of a price to book, comparing it to what its normal return on equity is. And then in times where we had higher rates, which you can see for a little while there. So that's the thing that's very attractive to people now, if you're looking at this, is, they managed to have, what did they do from 2000 in the last boom in terms of interest rates, 2003, 4, 5, 6. If you look at that chart there, you'll see.
Yeah, the return on equity went sky high.
Yeah. So it was
25%, 25%. Yeah.
Yeah. And so it's more similar this way to Frost, same thing, where it's very easy for people to think, oh, well, it's not that cheap. It's not really cheap. It's kind of expensive. But it's only really expensive if you count on the fact that the return on equity is as low now as it'll always be. So if their return on equity, well, I guess, so technically Frost did get below 10% in the pandemic. I don't know what happened there, actually. Why that happened. But other than that, it hasn't managed to be below 10% ever. And it's not way below 10% there. But you can see the 20-year chart, and you can see that it's been in the range of 10% to high teens. Mm-hmm. But it has a pattern that looks really bad, which is that it looks like it's been declining for 20 years, right? So that
return on equity, yeah.
Return on equity, yeah. So you're at 20 times earnings right now. Literally the PE is about 20, but you're about 20 times normal earnings theoretically. But that's normal earnings if there isn't any change in the interest, in the net interest margin. Whereas if interest rates were much higher, you would expect
that to shoot up a little bit.
The returns to be a lot higher. Yeah. Well, if you look, the biggest decline happened in a brief period of time, really, where it went. When is that? 2007. When did it bottom out?
2009.
2009. So it was 10% in 2009. But if you look, it declined every single year for that whole period, and it had started decline. That part, there's no change because interest rates didn't change during there. The part that you need to look at is if you go back to the beginning of that period. Okay, so in 2005, let's keep going right. All right, what year is that?
2005.
2005. So the entire decline is from 2005, where it's 18%, down to 2009, where it's 9%. After that, it doesn't decline. The return on equity stays the same. So the question is, will the return on equity always be 10%? It looks like it, right? If you look at it from that point on, it looks like it's 10% always. So if it's 10% always, you're paying 20 times earnings for the stock. So about the same you're paying for the market, probably. That's 20 times trailing earnings. Probably S&P 500 is 20 times trailing earnings. So why do it? Because rates were at about zero for most of that period. And if you look, rates briefly got higher. The Fed started raising it there at the end, right before the pandemic. Yeah. And you notice that it went up. Mm-hmm. So you can see that there's an increase in return on equity as you expect for a period of about 2 years or so, which is when rates were increasing. There's a little bit of a lag, but that was the brief period where rates were increasing. My point is that if you look, you might think, okay, I'm taking a 20-year period here, right? Mm-hmm. But actually, we got rates are the same, rates get cut. Rates are the same, rates get briefly increased, rates get cut to nothing again, and now rates are going to rise, but it hasn't happened yet. Okay.
It's kind of the same story, right?
That's all you have. And actually, if you look on, this is a perfect thing. People should go to QuickRS, look at this, and look at the return on equity of what I'm describing. Because if you didn't know what this chart is, it looks like a chart that matches up perfectly with the federal funds rate. Yeah. I mean, you don't know what the relationship is.
And what the Fed's doing with it.
But what's happening is that when the rates are like 6% and even, this company's earning 18% return on equity. When the rates are getting cut and they're nothing, it earned 8% or whatever in the pandemic, But as you can see, it's very stable in periods where rates don't change. So rates basically didn't change. Shorter term rates are much more important to this bank. So rates didn't change. Shorter term rates really didn't change much from 2009 for what? Let's say 8-9 years, something like that. It was basically the same. And you can see it's really no change. during that whole period. It's going to spend a bunch of money to expand into a few different places in Texas. Texas is a pretty fast growing place. I think there's opportunity here. I mean, you can do, what do we have? Can you do quarterly? Yeah. If you go to quarterly, stay on this page, we go to quarterly. Do they still calculate loan to deposits for us?
Yeah.
Okay.
Very low.
Yeah. So what was loans to deposits at the end of last year?
38%.
Yeah. And I think that there's probably a pickup in the kind of lending that they do, probably right at the end of last year. But, that's the end, December 20 of 2021, where I would have expected that it would be starting around then if you look at what business is expanding and everything. But it was very low. In fact, is that the lowest they've been?
Yeah. Mm-hmm.
Yeah. So.
Throughout this quarter. I mean, we can
go annual, but I think it's also the lowest.
Yeah. Mm-hmm.
Yeah.
Usually hovers around high 40s to low 50s.
They were in the 30s during the probably late 80s or something like that, around that time. So, but I'd say since then they haven't been this low in terms of loans to deposits. So maybe that's something that you don't like because they're not lending out a lot of money. But on the other hand, if you think about it, even if you buy short-term securities, you could make money now if rates were higher. So if you imagine, what if you had a 2-year or 5, whatever, that is, around 1.5% to 2% instead of around 0, like it was pretty close to 0 just in 2020 when they had poor results, So 2 to 3 year probably is like one of the most important parts for them, I would say, because these kinds of loans are fairly shorter term, and usually they've been buying really shorter term securities. Not always. Some of it does go out longer, but compared to most banks, the absolute level of interest rates probably matters more, and the steepness of the curve matters less for them.
I think this is the last bank that you wrote up. BOK Financial. Well, actually, we have Commerce, but BOK Financial.
Mm-hmm.
Any thoughts on this? And I'm kind of curious to hear after you give us your thoughts, kind of where this stacks up next to Frost and
not
Commerce.
One of my favorites.
And Bank of Hawaii.
Probably not one of my favorites. I'd say for most people, it's more going to be one that they like more because it does try to grow more, but it tries to go into new markets and grow. And I just think it's tougher to do that. I think it's been hard for them to get really good returns doing that, as opposed to Frost, which is a lot of organic growth with the same customers and things like that. Actually, the underlying numbers for Frost are really good when you think about that the net interest margin declined and that there hasn't been an increase in net interest margin. The fact that you could have the same return on equity over time is pretty good. It would be hard for me to pick it over Bank of Hawaii or Frost. However, it is cheaper.
We got 1.3 times book value, 10-year median returns for return on equity, 10.1.
And we just talked about Frost and Bank of Hawaii, and they're both, like 2 times book?
Mm-hmm.
And much higher PE multiples, same thing.
Loan to deposits are, it looks like sort of it's 50%, and that's a low, it looks like, just glancing over the history.
Very big historically in energy. So the bank's controlled by someone who made all his money in energy. Like Oklahoma Natural Gas, I guess, was mostly how he made his money, something like that. So I think I'd have to check, but both Frost and BOK Financial are considered energy lenders. They're pretty big in that. So energy lending has really declined in recent years. It's a much smaller part of Frost business now, and maybe that's part of what you're seeing here. I don't know. Or they had a lot of deposit growth, because you had the pandemic. So
Commerce, bank shares.
Yeah, it's not that exciting. Commerce and what's the other one that we didn't write up? Trying to remember. Let's see. Anyway, Commerce is controlled by a family that they have like cousins basically who control another bank that we could consider writing up either one of them. They're in the same sort of part of the country. I don't think there's that much to be interested with there. What's their price? Yeah, I don't.
2.5 times book.
I don't understand that. Yeah, I have no reason why I'd prefer Commerce to the other banks that we've looked at here. At the time that we looked at them, you have to remember that the prices were different, so that affected how attractive it was. Like, I really liked Frost at the time that we wrote them up, but what was Frost's like just stock price when we wrote it up?
It was
so
$61.77.
Now it's probably double that. So to give you some idea, the stock is probably doubled. What's it at now?
138.
So more than doubled. And it's important to note, I never would have imagined that it would be this much longer and we still wouldn't have rates increase.
Mm-hmm.
That never could have been something that I could have foreseen. In fact, they shortly after we wrote that report, they started raising rates.
Yeah.
Then they stopped raising rates. Yeah. And they had
reverse
a huge
course
pandemic,
pretty quickly.
And then they waited a year when they had transitory inflation. Mm-hmm. So we never could have imagined that it would be.
And it's done okay. It's done great.
The prices, that's what I mean. So the prices doubled, and yet it's had a situation where, if anything, interest rates have been worse than I could have expected, not lower than I could have expected for them.
Well, it's re-rated a lot recently since the talk of rate hikes have been on the table.
Right, exactly. And then I also think it'll be a little more costly for them to go into the markets that they're going into. But in the long run, it'll help them. But it'll keep their earnings down a bit because opening new bank branches is not, I mean, the economics of a new bank branch for them is nothing like the economics of an old branch. You just don't make a lot of money right away doing it. And to enter in completely new cities, pretty much, you have to do a lot of advertising and you have to open up a lot of branches and you don't have the density that you want to achieve everything right away. So it's a long-term investment to do that. Because they basically weren't in Dallas and Houston as big markets for them. This company's not publicly traded anymore.
Breeze Eastern.
Yeah.
Acquired by TransDigm.
Yeah.
Do you remember what they were acquired for? Was it $18 a share? I can't remember.
Don't remember.
All right, not public anymore. I believe, is this company public still?
Which one? Nope. Taken out.
They were taken out as well.
Yep, this is Stressless, the brand that they make, which chairs is Stressless. It's
Recliners, correct?
Yeah, Norwegian company, right?
Fossil.
They still exist. They had problems right away.
Mm-hmm.
Yeah.
I think you did a couple. You did Movado and Fossil, right?
Yeah, Movado's very different than Fossil, though, yeah. Movado's a value stock. Fossil is not. And it's been, you can see how much it earned in the past. It was a fashion thing. It now earns like 1/10 probably of what it used to earn in operating profit.
$567 million in the past. Yeah, $124 million.
Okay, so it's recovered as of this year, I guess, but very fashion driven. They do have a lot of licenses and stuff, but much more female, much more fashion driven. You can see their long term chart. Look what happened there.
Yeah, 16, 17.
Mm-hmm.
Got it. So we talked about Frost, WW Granger.
Yeah, I think we've talked about Granger before. I rewrote up Granger again for the website. I did Granger and I did Car-Mart because they got to a price that seemed cheap, both of them at one point.
You like that situation where the stock price has gone up since you've last profiled the company, but the valuation is either the same or cheaper?
Yeah. I like that in some cases. It depends on how much I like the business in the first place.
So why are their gross margins much higher than most distributors you come across?
Turns are slower. So generally with distribution stuff, people make a big deal about how big the margins are and everything. But if you look, there's much less variation in return on capital. Distributors that turn faster have lower margins, and distributors that turn slower have higher margins. Granger keeps a lot of stuff basically in stock, and so it has lower returns on that kind of thing. Whereas the lowest margins you're ever going to see are like someone who just distributes cigarettes, or maybe a drug distributor, but they actually have incredibly high turns. They don't actually hold on to inventory for any real length of time. Whereas something like Granger has to have a broad catalog, and some of that catalog has to actually be in stock because they're not frequently ordered things,
Mm-hmm. So you wrote it up at $229 a share. It's at $483 today.
Yeah, so these are controversial always. So Fast, you can do the ticker on that one. I did not write that one up, but the ticker is Fast.
Is that Fastenal?
Yeah.
Yep.
Didn't write that one up because it was expensive then. It's probably expensive now. Great company in the past and everything. I don't know that I saw a big difference now between how Granger and MSC Industrial Direct would perform versus Fastenal.
Which you also wrote up.
I wrote up MSC, but I did not write up Fastenal.
Correct.
Yeah, because it was tended to be much more expensive stock, and while I felt there was a big difference in performance between it and others in the past, I wasn't convinced that difference would continue into the future. I felt the businesses were converging more, I guess you could say. But because of it's a much more popular stock, I guess. Granger also, I don't know the situation now because I haven't looked it up, but Granger also owns a publicly traded company, owns a large stake in it. It's not that important, but there's a Japanese company that's publicly traded, and Granger had owned a large stake in it. So unless they disposed of that, then that's meaningful. That company always traded at a very high multiple compared to Granger, so it was often kind of, if people wanted to, they could of course short that and go long Granger, for whatever reason. I think just because it's growth stock in Japan, they just have a much higher multiple as growth things in the U.S. is online stuff. These stocks trade a little weirdly. They trade very much based on economic expectations. So you could do Granger and MSC both to see the multiples on them. You can get some ideas.
Wow.
Yeah. So they're somewhat cyclical. They seem to trade on the cyclicality much more. So MSC Industrial Direct is much more tied to metalworking in the U.S., like machine shops kind of stuff, which hasn't been a terribly big growth industry for the last 10 years or something, because the U.S. economy just hasn't grown that much, in nominal terms and things like that. Some other things that Granger's much less exposed to that, so it's less economically sensitive, you could say. I think it would be better if you were a long-term shareholder of these things. The trading seems to be very dependent on, obviously people can find manufacturing activity indexes and things like that. These are leading financial indicators, economic indicators, and predict what return on capital for these companies will be. So you can see that the return on capital changes depending on where you are in the cycle. It's pretty easy to see that. And earnings change too for that reason. So they're cyclical, and they're very cyclical depending on the overall state of manufacturing and other things, but mainly manufacturing in the U.S. So maybe timing it so that you buy it at a point when people are selling it because they're not optimistic. So what will probably happen with these stocks is they'll go down. When these stocks go down together, it probably means they're expecting a recession in the U.S.
Uh-huh.
So that may be when you get a point to buy them if you want to. They just seem to trade very much on that. I think they're almost all have high share turnover and stuff. I don't think any of these are overlooked, to be honest.
Yeah, 200%. Hunter Douglas, no longer public.
Yeah, went private.
John Wiley and Sons.
Mm-hmm. Hasn't done much of anything interesting.
Lifetime Fitness.
Private.
Luxottica.
Merged.
Movado. That's public. Value stock.
It's not as cheap anymore, right? Let's see. MOV.
Looks like 1.7 times book, 0.8 times EV to sales, or EV to free cash flow 5.3 times.
Yeah, I guess it's not. It's still pretty cheap compared to the other watch companies, I guess. Yeah, that's definitely a value stock thing. So you were saying before, the picking stocks for longer term, whatever things. Movado wasn't. I mean, Movado was basically it's a lot cheaper. If you look at that, do you have the report from Movado?
Sure thing.
So you could look at the table on it. If you look, you'll see on the that valuation thing is good. up in that upper right-hand corner.
Yeah.
Yeah. So if you look, you can see what the median is and all of that.
Mm-hmm.
You'll have to zoom in to be able to see it. So if you look at the companies that's compared to, the EV, let's see, EV to EBITDA, for instance, on Movado was 5 when I wrote it up. It's not much different now. And for all the other companies in the industry, it was, 7 to 13 or even more than that, right?
Mm-hmm.
Yeah. So all the watch companies are a bit more expensive. There's a pretty low multiple on it. I don't know how different it is now. It seems fairly cheap, I guess. But obviously things have moved along in the watch industry that's made it less attractive over time. The big thing that happened with watch things, Swatch and other ones like that, is you had huge declines worldwide, much less so in the US though. But Swiss watches are not something that Americans buy a lot of. They're much bigger in Asia and Europe. And obviously there's a big decline in demand from China. So you actually had Swiss watch exports decline in some of those years, which hadn't been the case for a long time. Movado, although an American company, it makes licensed stuff in Asia and makes Swiss stuff in Switzerland. So it's actually kind of the business that it's in. And we'd written a little bit about that because there was like a crackdown on corruption stuff in China, and we talked a little bit about it with Swatch, about how much of its profits and stuff really come from that. So again, I think that those ones, they performed badly mostly for the same reasons as the fossil and watch companies and things like that. I mean, Movado is pretty cheap, but I would say those things are like fashion-driven things. The same thing that I would say with exercise things, Town Sports, Weight Watchers. I mean, Lifetime Fitness did fine, but you can see that the results for most of these are determined a lot by what industry they were in. Mm-hmm. The insurance things did great. Progressive and HomeServe,
Progressive, HomeServe.
Yeah.
We've spoken a lot about Omnicom. Prosperity Bank Shares was the other bank company that we've spoken about on the podcast a few times.
I think the data's wrong on QuickFS for Prosperity.
Okay.
I think there's some problem with it. You can see in their presentation and stuff something different. So I think it looks cheaper than it really is, but I could be wrong unless something's changed a lot with the stock. I believe that some of that information there's something off about it. Prosperity is the other big bank in Texas. So those are two of the biggest banks. And I'm not sure which one I like better and stuff. I mean, I liked Frost better because I thought Prosperity would require continual acquisitions over time. And I think that most banks that require a lot of acquisitions over time, it's hard. They get too big. It doesn't work.
That's how Prosperity grew to be the size that it is, right?
Yeah. Frost does very little acquiring. They've acquired some things. They just acquired to enter that area. They're not usually very picky about price. More culture and just someplace they want to be. So if they wanted to be in like Houston or whatever, they might acquire something to go into there.
So we've spoken a lot about Village Supermarket. So another name that looks interesting to some people, Tandy Leather Factory. We've spoken about it before on the podcast. And you also wrote it up.
Yeah.
Any thoughts on Tandy? They've been going through a lot of changes.
Ton of problems since I wrote it up. Yeah. A lot of problems. And then with the pandemic and everything, that doesn't help for a company that, although it sells online stuff, has a lot of in-person business. Failed to have SEC reports for a while, so they were out of date with that. Now they're back though, right? And they are, yeah. And so they don't trade on the Expert Exchange anymore. The Expert one, they're OTC,
yeah,
but they're like regular pink or something.
We could look it up, but
yeah. So if you're non-current, they're regular pink. So some people listening to this might have trouble buying and selling securities. If you use like Interactive Brokers or something, they won't let you, right?
That's correct.
So you may have trouble if they're not current in their financials. So there's a period here, which is fine because probably the period where they were non-current is the period where the stock was at its cheapest. So it's good. It's protecting you from yourself because you might have sold it otherwise. But when they can't file their with the SEC, they then aren't current for purposes of OTC markets, which means that because of some new SEC rules last year, they'll be put on this expert thing that you'll see, which is, it does look like a black diamond. What does it
does,
like? Yeah. And that will mean that like our fund and stuff could probably trade it and you can't. to be honest about it.
It's a very odd thing, I think, because you talk about like America, capitalism. I mean, it defies that, in my opinion, and kind of similar towards like accreditation rules and stuff like that. But that's another podcast.
And I'm kind of more okay with it, because there's two sets of companies that end up in this category. Perfectly legitimate companies there's really three. There's things like Tandy and some other companies which just failed to be current in their finances for a little while. There used to be companies on exchanges and stuff that had that problem. So that can be a one-time thing. That's what happened with Tandy. They fixed it. They used to be on NASDAQ, right? Yeah, they were a NASDAQ company, yeah. So they were basically about the size of an ARC restaurants on NASDAQ. Everything was the same as like ARC restaurants. Then they now they're on Pink. That's one. The other category that you get, which is a bit of a problem, is more what we would buy or talk about on this podcast, which is a company that's perfectly legitimate business, has been around a long time, is probably pretty good business, doesn't want to give any information on it. And so those are kind of worse when that happens. Like as bad as like Maui Land and Pineapple is right now, it's on an exchange. If they just stopped reporting stuff, they would end up on this expert thing, and they probably would be perfectly happy with that because they give the minimum of information to talk about their company now as it is, you know. The thing that it's meant to protect you from, though, so that you should be able to buy, an individual investor should be able to buy, and that's fine. And there's lots of companies that give very little information, and you should be able to buy them. That is not what the SEC is trying to protect people from, though. The kinds of things that we like of the overlooked stocks, they're really trying to protect them from the ones that are putting out press releases and are encouraging trading activity in their stock, and not providing financial information, right?
Yes.
So the ones that put out and say, we signed a new deal, we got a new customer, our mine came back with this amount of concentration of these minerals, but it refuses to be current in their quarterly and annual stuff. And the public probably should be protected from companies like that. That's not the kind we look for. Those are usually high share turnover, penny stocks, and, you know.
Pump and dumps.
Yeah. So the SEC thing, the good news, bad news. In some cases, the bad news is, right, some of these companies decided, well, then we're not going to give information at all. We like going on the expert thing. It'll just make our stock less liquid. We have to deal less with outside shareholders. We're happy about it. Those might be people stripping their company of stuff and things anyway. However, it improved some. We've talked before off the podcast about things that used to be that you could only get the information by contacting them and say, send me your annual report. They would do it. So you buy some stock, you say, send me the annual report. They have annual reports. They have letters to shareholders, all that stuff, but they wouldn't put it up on a website or anything where else. So if you weren't a shareholder at all, and even if you were a shareholder, you had to contact them, you wouldn't get information. Some companies also would just give you the information if you talk to them.
Just need a little legwork. But no, you're right. There's a lot of companies that were sort of hidden a lot of their finances and stuff like that, that decided they wanted to continue on and not be on the expert market. So they uploaded their financials past years. And
most people listening to this, I bet, if you looked up a company and there's no way to find its financials without just sending an email and they'll send you the financials, you wouldn't do it, even though it takes 2 minutes, right?
Sure.
Because you just you don't know anything about the company, and at the point where you can't find any financials on it, you just drop it. You know, so that's what happened with Tandy. Their stock obviously went down at that point. The problems are more the problems with the business they had. They did the things that we kind of were worried about, which is mainly trying to expand more the number of locations that they had. That became a problem. Again, this is a story that a lot of these companies we talked about had. They run out of abilities to grow, and then the difficulties that they have from some things of trying to keep that growth happening. And that happened with Tandy, and I think it's happened in the past with Tandy. So they tried to do things like expand the size of, instead of doing more stores, expand the size of a single store. But then that's not really driving up the higher sales per square foot. So I think they've had problems with that. I think they kind of saturated the market in terms of their size in the U.S. And they'd been at that point before in their history, kind of under a different company name. well, actually kind of same company name, but different company it was. And so they've done this as like a predecessor before. And then you grow too much if you kept doing it. And I think that's similar to what we said with seeing the decline over time with what became B&W Enterprises, Babcock and Wilcox. The part of the business that didn't have any growth ran into problems. I think that's the answer to a lot of these companies that haven't performed well. If they didn't perform well, sometimes it's lack of durability, fashion, health, health, what do we want to call it? Diet and exercise. Yeah. Those are the bad things. Those companies have durability problems a lot. And then the other category that has problems, I think, because it becomes so dependent on capital allocation, is companies that can't grow at all. ARC ran into that problem too, weirdly, because their stores their restaurants don't really grow because they're already at capacity. Not quite capacity, but they're already quite full pretty early on. So if they lose a lease, then they can't grow over time. And they had leases instead of owning restaurants outright, and now they bought them. So they dealt with it by paying dividends, which you talked about. So at least in that case, you don't have a big loss because of that. But I think that happens to a lot of these companies. If they don't have any growth, they can become riskier.
So looking at all of these companies, after going over them today, if you were to hone in on any company, let's say just one, which would it be?
America's Car-Mart.
America's Car-Mart. There you go. Because it's super cheap?
Yeah, like price and things like that, I think. Mm-hmm.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding Podcast. If this is the first time you are joining us, be sure to hit the subscribe button wherever you're listening or watching us. If you are interested in meeting up at Berkshire, we'll be there Thursday to Sunday because you're a qualified investor or just accredited and you're interested in learning more about us and our money management services, either through the fund or the managed accounts. Reach out to me at andrew@focuscompounding.com. Thank everybody so much for all the support, and we will see you in the next podcast.